Pillar of any Benzinga event. The one, the only Tim Seymour is going to be coming on, dropping knowledge bombs about his ETF. He's going to be interviewing two powerhouses. He joins me. I feel like I need to bless the virtual stage.
Oh, stop it, dude. Come on. This is getting ridiculous. Please. Come on.
He's like, shut up, Elliot. No, Tim, it's always good to have you, man. It's good to see you.
It's great to be here. You guys have gathered the galaxy of cannabis stars for sure. So congrats to Benzinga once again.
Thank you. It has been a long 2 days, but honestly, I'm not tired. It's just listening to one presentation and fireside and panel after the other. So what I'm going to do is get out of your way and tune into you.
Okay, Elliot, thanks. And hey, good afternoon, everybody. I know it's been a full couple days, and I think there's probably an hour and a half left here on a Friday afternoon. So we'll try to keep this brief. And in fact, my segment is, it's around education. So you've been listening to fantastic investors all day, including the last panel. I'm going to try to give you some thoughts on how I approach the sector, how I think about investing in cannabis in the public markets in an ETF format. Real quick, my background is in emerging markets, and on some level, I'll get to that in a second. I think about these markets very much in the same context. But quickly, I am Tim Seymour. I run CNBS, the Amplify Seymour Cannabis ETF. I'm also a member of the investment team at JW Asset Management, and we're excited to talk to Jason Wild and Chris Weber in about 15 minutes or less, and really hear about an exciting project, the Weber Wild Fund. But my orientation on cannabis is as someone that's been investing in the public markets, the private markets, really, from early days. And I also sit in an advisory capacity to a number of companies. So from that perspective, I want to give you my thoughts on how I think about investing in cannabis. CNBS is an actively managed ETF. Real quickly, we are 150 million under management. We're up about 51% year to date. The approach is absolutely dedicated cannabis, which means that 80% of the portfolio must have more than 50% of their revenues coming from cannabis. So that means not tobacco companies that might be here someday, or pharma companies that might be here someday, or companies that do a little bit in cannabis. It's to be invested on companies that are really big players in the sector. We can touch the plant, and I'll say, as an evolving dynamic for the industry, we've probably heard all about the federal restrictions on the industry in the United States. That has applied to the investment world, but we're happy to say that we can now invest via swap in really anything we want in the public markets, and that's really exciting. We're investing in ancillary, we're investing in technology, we're investing in picks and shovels, but we're investing in hopefully the most profitable companies in the space and the ones with the most upside. I think the idea behind an ETF for investors, whether you're investing in e-commerce or blockchain or emerging markets, an ETF that is sector-based should be thematic. And in my view, thematic in the cannabis sector means a very quick evolution of the themes that we've been investing around in cannabis already in the first couple of years. But active is very important, because not only are we seeing the sector continue to have dynamics around M&A and look, new listings. I've been able to invest in 3 different IPOs in the last year or so in the fund on day one as part of that. So the M&A, the IPO calendar, corporate governance is absolutely a major dynamic to investing in any new industry, in any emerging market. And I think that's a big part of how we evaluate the sector. Look, momentum, technicals, liquidity dynamics are constantly changing in this industry. At times we've seen massive liquidity surges, and we've seen liquidity dry up. The last 6 weeks have been relatively light in terms of liquidity, certainly relative to what we saw in the first 6 weeks of the year through mid-February, when the sector was on fire. I think of cannabis as an emerging market, I said. And so I ran a long short EM hedge fund for 13, 14 years. And to the extent that I think of the cannabis trade, and I express this in the portfolio as a top-down trade, a bottom-up trade, a trade that's ultimately focused on corporate governance, some part momentum, some part liquidity factors, and some part structural. So if you think about it, in emerging markets back in the late 90s, you were often investing just based upon who was going to get the next tranche of IMF money, or what country was going to improve their macro balance sheet for any number of reasons, and that was enough to pretty much buy the whole sector. Cannabis has seen that too. Cannabis has seen that as it relates to absolutely the federal dynamics, and certainly we know that started north of the border, and Canada's momentum, some momentum around the world, and then obviously the momentum around the political change in Washington into 2020 and what that meant for the prospects of federal legalization here. Investing in cannabis macro is very important. Getting your macro right is very important, but kind of like emerging markets, it's not necessarily why you're investing here and now. You're investing for this macro growth trend, this turbocharged addressable market dynamic, and actually, unlike in the emerging market space where you might want to invest in a Brazil, but you might not want to invest in a Turkey. In other words, not investing in a bad neighborhood. I think in the cannabis space, the neighborhoods are the subsectors, and so the subsectors are clearly, whether it is technology or retail or e-commerce, or to the extent that we're obviously then very focused on retail as it relates to multi-state operators or the LPs that have that retail footprint. You're thinking about cannabis in the context of macro, but then the bottom up is very important. And what we're starting to see now, and the way I believe I express this in the portfolio is that we're starting to see companies separate from the pack in terms of, look, if we talk about the MSOs, we can see the companies that have dramatically improved gross margins, profitability, are 3, 4, 5 quarters into a free cash flow generation. That's very impressive. And we're now looking at, we get into the second half of 21 and into 22, those operators that are really seeing this hockey stick. Remember those hockey sticks that we were talking about in 2018 that were going to be 2019 that never really happened? But the cultivation that's coming online, that's really going to define the differences, I think, for a lot of these companies in 2H21 and in 22. I think the most important thing for especially retail investors in investing in cannabis, I think, is trying to balance the fundamentals and the macro, whether it's what's happening on the federal side, what's happening state by state, which frankly in the U.S. continues to be where the momentum every single day. There's a new headline about a new state coming online. That's for investors that spend time combing over the macro. In a couple of years, we're going to look back over the fact that we're seeing this thaw in the Texas legislative track, or what we see, especially in some of the really conservative southern states, as being, I can't believe we spent so much time on it. But I do think that the macro is really important. I would tend to say, though, investing in cannabis is really pragmatic investing. And so in a world where the hockey analogy, right, that's way overused, which is skating to where the puck is going. For me, it's really about investing where I think the capital is going. So at a time when I can invest in U.S. companies, I can invest in Canadian companies, I can invest in companies in Europe. On some level, part of my job as a portfolio manager is to try to evaluate where I actually think capital is going. We all know where institutional capital has had issues investing in the sector, where we've had big U.S. mutual funds that were invested in MSOs that had reverse field because someone got a tap on the shoulder, or some custodian said you can no longer custodize it here. There are obviously many dynamics on investing in U.S. LPs versus U.S. MSOs that at times are very emotional topics. They're topics that I think the fundamentals in north of the border and in the United States are very different. But for me as a portfolio manager, I'm investing in companies that I think can go higher. And that's based upon fundamentals. It's based upon technology. It's based upon many times liquidity and momentum factors. Yesterday, I was tweeting out something on Tilray. And in the middle of what's been another crazy week around Reddit investing, my tweet was Tilray, Reddit, or real. And clearly Tilray, especially in February, was a 22-25% short interest stock that was really caught up in some of the bulletin board activity, and maybe this week it was as well. There's fundamentals around why Tilray would be a fundamental choice in a world where they are not only one of the better operators in Canada, but are positioning themselves for U.S. Access. And maybe, though, if you have a view on the federal dynamic, many investors think investing in some of the Canadian LPs is the way you get that exposure. I'm not going to tell you whether I think that's the right thing or the wrong thing. I have a view, but I'm more pointing out the pragmatic part of what I think I'm supposed to do as a fund manager, and is to not get overly righteous necessarily about fundamentals if I think that there's capital flowing into a particular name. Yesterday, I was actually fading a little bit of that strength in Tilray, which is a big position in my portfolio and one that I've been adding to in the previous few weeks. Because I think that's what I'm supposed to do on a day like this. I'm happy to say that as a guy that ran long short EM money, many times in emerging markets, when you're dealing with currencies and macro and the fundamentals around the stock and the exogenous factors, sometimes we were over trading, and sometimes running long short anything means you're over trading. I think in an active ETF, I think you're in a position to really hopefully balance the combination of I can fade strong moves, I can buy extreme weakness, I can buy fundamental changes that I see happening, but the key really is that I'm able to be reactive or proactive, but not overtrade, which I think at times when your mandate is a low vol absolute return long short equity strategy, it's what you do. In terms of things that I think investors should also be thinking about with regards to the next wave of investing in cannabis, it's very clear we're going to continue to see more subsectors develop. I think the REIT sector's now been a relatively broad place on a relative basis to invest in cannabis. The retail space, as it relates to the hydroponics retailers and the picks and shovels, I think we're going to start to see a lot more as it relates to technology, but as it relates to where there is software and where there are ERP and logistics and some of those sectors that I think it was exciting to think about them early on, but really there was almost nothing to do. I think the important thing for investors to remember is also where, I say this all the time, but where global markets and are still going to push this sector around. So if you get a case where yes, we're near all-time highs yet again on the S&P, and yes, the VIX is around 17, but the minute some of those factors change, I think you have to think about your cannabis investments in terms of the volatility profile, and it may have nothing to do with the fundamentals there.